I think there isn't a lot of U.S. exposure in Argentina right now. The EM has not been a hot trade, so there isn't a lot of money that needs to fly out of it and run back to the U.S. I think the bigger issue here is just emerging markets more broadly. You have a lot of emerging market debt held by Western banks. U.S. investors probably have exposure to those Western banks and other entities. So it's a second derivative, right? It's secondhand exposure, so to speak, that could hurt the U.S. I guess the other place it can hurt the U.S. is just multinational businesses. Just like with the trade war, as the world gets more and more interlinked, a problem in a small place, Cyprus, Greece, Iceland, can have global implication just because of all the financial and trade links. So that's how I'd view Argentina. I'm much more worried, frankly, Sarah and Wilf, about Turkey these days.
Go on about that. Why is Turkey more of a concern for the U.S. than Argentina is?
So, again, it's going to be secondhand smoking here. It's going to be going through Europe. But the issue with Turkey isn't so much the size of the economy or the holdings of bank debt by Europeans, although that is material. The big issue here that I think people are underestimating is geopolitical. Turkey is incredibly important strategically in terms of where it's located. The Europeans have given Turkey a pledge of 6 billion euros to prevent migrants from coming through North Africa and the Middle East to Europe. Turkey's holding them back. If Turkey's in dire enough straits and they need financial aid, they could basically tell Europe, you give us money or the migrants come through. That creates its own political and economic headaches for Europe that it can't politically deal with anymore. If Europe says no, Turkey may go try to have talks with Russia or Iran or other countries to get the aid, which obviously Western Europe doesn't want to see that geopolitically important country building bridges in that direction. So I think this one has contagion risks to the Middle East and to Europe, and both of those could impact U.S. companies and U.S. equities via sentiment.
Since we're talking about hotspots, Rebecca, another group that investors are worried about are the countries that are also being targeted as a result. Brazil, and these are bigger economies and much more important. Brazil, Russia, South Africa. That seems to be the next group in line in terms of the firing line right now. How concerned are you about that? And if those currencies get weaker, does that have the potential to have a bigger spillover effect?
Sure. No, I think there is risk that this could spread, and Brazil is particularly important because they have an election coming up in October. There's a lot of uncertainty around that. The currency is weakening. It could force the central bank to raise rates a la Argentina or Turkey to a lesser degree. South Africa as well in the crosshairs, Russia, Indonesia. And Wilf, you mentioned at the top of this piece the ETF, emerging market ETF. That's a big part of the problem today. With more and more money going into these sector or regional ETFs, it's harder for a lot of investors to distinguish the better and the worse emerging market countries. All of them go up and down together as flows go into these emerging market ETFs. So active management really important here, and that ETF outflow can affect a lot of countries, even if they don't have those same financial or political vulnerabilities.